A lot of them are typing. Let me see. Any strategy, the only strategy is non-directional, which is covered in XLT. There are no directional strategies. If you want, you can take synthetics or futures, whatever is your choice. What about the others? Any questions? Everybody's understood all the strategies, at least from a theoretical standpoint. A lot of them are typing. Let me see. Yeah. A bull put spread what? Please means Anand. क्या चाहिए आपको? आप सवाल पूछिए ना जरा, तो आंसर देने में भी मजा आएगा मुझे। सिर्फ ऐसे बोलोगे सर एक बार प्लीज यार एक बार बुल पुट कर दीजिए ना प्लीज, इसका मतलब क्या हो गया? तो सवाल पूछो। Okay, Anand is happening. Let me just finish with this question of Anand and then we'll start. How do we determine the put strike price of the anchor and offset? Yeah, that's what we now when you take an example you'll come to know. And what do you mean how do you determine? You know the rules, right? Okay, let me tell you how to figure that out. So all of you will have access to these handouts which are available in the student lobby under documents. So if you say bull put is a bullish strategy, so when I go to this point, this slide, bull put spread, strike selection, anchor at or below the distal line of demand zone used for entry. So what you do is wherever your stop loss or distal line is, see that price, then go to the option chain and find out the closest strike to that price. That's it. All right. Okay. Should we begin with our RR calculations? Okay. Now everybody has to pay careful attention to this. Which doc? Okay. So also guys make use of student support. Okay, student support will help you with this. So after the class, if when the instructor is not there, right, you can go to the student support guys and they will help you with this. But right now I'll show you where it is available. So when you go to your Professional India Options Trader online, you see these docs. These are the docs. See these reference cards? This is where all the docs are. We all have to also ensure that we explore the website. Once you explore the website, you will come to know everything where it is. Okay, now let me see if I can plan some trade here. Dot del. Which is that? Oh, this is for ELD. This is for trade station. This is for trade station. No, we don't need this because we already have this, right? Trade Tiger has this. Okay, so let's do one thing. All right, let me just look at this. Okay, so what we are going to do now is let's assume that the demand zone that I have marked from 652 to 583 is the demand zone that we are going to use for our trade. All right. Okay, so let's just say this is the trade setup that we are going to have. That is, this is going to be my entry. This is going to be my stop loss. And let's say this is going to be my target. Okay, so that's a trade setup. So I'm not going to get into the core strategy details right now. So assume that this is a monthly income trade. Okay. Yeah, stop loss. I'll add the stop loss part. Okay. All right. So this is the setup. So let's go till we'll have to create Excel sheets. So Nifty, my outlook is bullish. Time frame is daily, and the IV is in section 1. Currently, where is the IV? Section 3. All right. So we are going to just make an assumption that it is in section 1 now, because otherwise I won't be able to explain to you the calculations. Okay. So assumption is section 1. All right. Is everybody with me on this? Remember, this is an assumption. Again, I am repeating, the volatility actually is in section 3. All right. Volatility is in section 3, but I am for example purpose assuming that it is in section 1. So I hope there won't be any new questions on this. Why section 1 when it is showing section 3? Okay, let me just refresh. Oh god, Ray Tiger has slowed down. All right. Okay. So when Nifty is in demand zone and we are bullish, or we're trying to look for a bullish trade in Nifty, it is coming into that demand zone, section 1. What should be your strategy? Long call, long call. All right. So the strategy here is long call option. Now let me just put in those Nifty values. Entry is at 10.6. 10655.75. My distal line is 10583.65. 10583.65. My daily ATR for Nifty is 113. Current market price is 10976. 10796. My target is 10980. Supply zone starts, let's say, at 10980. That's my target. Is everybody fine with this up to this point? Okay, so I've just noted down my entry stop target values here. Alright. Now the entry is this. That's your entry. This is your okay, it's written here. And that's my target. Alright. Is it everybody with me on this? Yeah, I'm assuming that IV is in section 1, Rameshji. Okay. Now we go to options oracle. Once you install option oracle, this is where the option chain comes in. This is where you have to type in your uh, stock or index, whichever you want. This is where you will create your strategy, and this is where the whole summary will be noted down. Okay, so we are looking at Nifty. I'm just going to refresh this. Okay, because I've taken all the strikes, this is coming a little delayed. That's not a problem. Now the next step is to assess liquidity. So you know where to assess your liquidity from. You just have to go to the front month option chain. The first part is add these two divided by the lot size, and it has to be greater than how much? 10,000. Then look for add the money strike options and check their volume. They should be greater than 300. And also add the money bid ask price should be less than 10% of the options premium. Perfect, Ajit. All right. So Nifty by default has is satisfying this condition. All right, everyone. Okay. Now, what are the rules for us to select our strike price? So once the stock comes to the demand zone at 10,656, what's the rule to select the strike price? Choose strike at or below the demand zone, isn't it? At or below demand zone. My demand zone distal line ends at 10,570. So let me go and check in my options chain which is the one that is closest to 10,570. 10,570 means 10,600. Either 10,600 or 10,500. We choose 10,600, which is very close to the stopping point. Okay, this is how you select the strike. If it was 10,540 the distal line, then I would have chosen the 10,500 first. But since it is closer to 600, I will choose the 10,600 first. So my strategy is going to be long 10,600 call option. Okay, 10,600 call option. And when you're buying option, which month you have to use? Far month, which is going to be March, April, May. Right? So the strategy is long a call of 10,600 May expiry once the stock hits your entry line on the demand zone. All right? Everybody clear with this? Now let's see. Let's go to the May expiry for Nifty and see if it is available. May 2019. Now, what is the problem that you're facing here? Now, there is no liquidity. So, right, we will do what for this example purpose we'll do is we'll go to April. April, it's pretty much okay. 10,600. The spread is also not that wide. So, we are fine with it. All right. So, to simulate this trade and for example purpose, what we are going to do is we are going to choose April expiry. Yes, I'll so wait now, Ashish. I'm going to do that. So once this whole process is clear, right? All your questions will get answered. What all we have to look and where we have to look. So ideally it should be May 19, but for example purpose here, I'm like taking as April 19. All right. Okay. Fine. So what we do is we go to options oracle. Now let me delete all this. So right click and say add row in this strategy position. What is my strategy? Long call, right? Guys, answer fast because we have limited time. Okay. So now the strike is 10,600 and the expiry is April. Okay. The current market price of this option is what? 432. All right. So current market price for this option is 432. 432. Now, is this what we are going to pay for it? No, why? Because we are still not in demand zone. How will you say this is what we're going to pay when we buy the option? We are not going to buy the option now. We are going to buy only when the stock hits 10655.75, right? Right now it is trading at 10796. It has to drop down. So when this drop downs, should your call option also reduce in value? Because of the positive correlation. Now we need to know, if the stock drops down to 10655, what is going to be my what is going to be my options premium, isn't it? And the best case scenario is that the stock drops down today itself to your demand zone, so that all my other conditions remain same. My volatility, I don't have any theta impact, market conditions remain same. So the best case scenario is, if the price comes today there, this is where the same conditions can be simulated, isn't it? Okay, so what we do is, now we know that it is 432, and look at the delta. Delta is 0.61, which is greater than 0.25, no problem. Then I go to this graph. Do you see this graph here? Graph button. So when you click on this graph, this, it will show you the expiry graph for a long call option. Now does this look like a long call option graph? Okay, but remember, this is at expiry, and I am not interested in expiry, because expiry, what is the time value component? 0. So you see on the right hand side, do you see this T and E? Top right hand corner. T stands for today and E stands for expiry. T is for today, E is for expiry. So now this graph is at expiry. So what I do is I click on T. So this graph changes to today's graph. This graph changes to today's graph. So right now, this is the underlying price and this is the profit and loss. So what is our entry price on the underlying? 10655.75. Okay, so let's assume 10655. So what I do is, when I go to this graph, do you see this, the red cursor which is moving along the line? And when you move along the line, in the bottom, do you see this status bar? So as I move, the status bar also shows price and the PNL. Price, what price is that status bar and the PNL? Okay, so my entry point is 10655. So I will drop down till I reach 10655. So that's 10658, which is approximately close. The problem with options oracle, it is not be precise, but for simulating, we don't need the exact precise value. So plus minus is okay. So what you see in the bottom, stock price is 10658 and your profit and loss is 77 rupees, or let's say 78 or 77.75, whatever, 78, let's take 78, but it is minus. What does this mean? What does minus 75 denote to you? Yeah, the loss. If the stock drops down from the current market price to 10658, this is what is the loss that is going to be in the options premium. So premium will be 432 minus 78. So premium will be 432 minus 78. So that is going to be approximately the price of the option when it comes to demand zone, provided all other conditions are same. The premium, the likely premium when you enter when the stock enters your demand zone, this is the likely premium of 10,600 call option. Everybody's with me here? So I figured out what is going to be my approximate entry price of the option. So the current price is 432, but when it comes to my entry price, it is going to be 354. 432 minus 78. 78 has come from options oracle here. So when you take it to your entry price, it shows minus 78. Just subtract that 78 from the current market price of the option. All right. Ramesh, did you understand? These are all estimated prices, but they are fair degree, plus minus 10% they come in. Yeah, provided all other Greeks are constant. All right. Now, the way we found out, yeah, this would keep on changing. So just hold on now. Right now, just pay attention to this. Deviating questions will you ask me after I finish this. Okay. Now, so what we figured out is the current market price of my option. What is the estimated price of the option when it hits my demand area, which is 10655. Similarly, what is my stopping point? 10572. And the worst case scenario would be, when would you get stopped out in the worst case scenario? Today itself, right? If you get stopped out today, that's the worst case scenario. So let's see what is my maximum risk for this if I get stopped out today. So again, go to options oracle, and the stopping point is 10570. So just go down till you reach 10570 or up, just make sure. Okay. 10572, the loss is going to be 123 rupees. Do you see the loss? 123 rupees. Okay. So you will have to subtract 123 from the current market price of the script, which makes it equal to 432 minus 123, that is 309. So so the option, when you enter, the options price is going to be 354. If you get stopped out the same day, your options price is going to be 309. So entry minus stop loss is going to be your risk. Did everybody get this? So similarly, you'll have to find a target. What is the best case scenario for target? Today. So my target is 1090. Go to 1090, 10, 10, 10, 10, 10, 980, 10, 980, 10, 980. It will be approximately 123 rupees. 123 rupees plus. So 123 rupees plus means you'll have to add or subtract. Add. And that has to be added to the current market price plus 123. So that is 555. And so this is the options price when at entry, this is the options price at stop loss, and this is the options price at target. So entry minus target will be 201. What I'm having is a 45 rupee risk for a reward of 201. which makes it 4.45, and the current, and in the on the stock trade you get 3.88. So do you see we have a better reward to risk in our options for the same movement in the underlying, for same movement in the underlying. So that's how. So if this is greater than 3 to 1, and what are my conditions here? The minimum condition is delta should be greater than 0.25. That's it. No, for single leg calculations, Rameshji, there is no need of checking Vega, because Vega is whatever the system will provide us. For single leg, we cannot manage Vega. So the only way to manage Vega is you do it when volatility is in section 1. That's it. Okay. So that completes, this is how you have to do the RR calculation for any debit strategy. So you take the current market price of the option and then simulate using options oracle what if my stock drops down to my entry point today, what is going to be the new options value. Similarly, what if it stops me out today itself, what is going to be my new options value. And the best case scenario is it hits my target today, then what is going to be my, yeah. So this Excel has all the formulas, addition, subtraction. So when you see this here, it will be having all the formulas. So you should know that 123 comes from options oracle, 78 comes from options oracle, 123 comes again from options oracle. All right. Yes, Rahul, I'm going to send this to you. I already told you on day one that all these documents that I'm making, I will be sending you this. I'll send you this and you can modify this template as per your convenience. Okay. Now let's take a look at the position sizing. Let's say my risk. So what happens in case it takes time to reach to your target? What will you do, Rameshji? So if 30 days pass, if 30 days pass and it is moving nicely towards your target, just make sure that you roll it over again to minimum 90 days. Okay. Now let's assume that my risk per trade is going to be 10,000 rupees. Alright. So here I will show you the comparison between a stock trade, an options trade, and a futures trade. So now all these values are automatically taken from here. Okay. The risk amount is entry minus stop. That is 10,572 minus 10,5,565 is what is 83.4. So how do you calculate the position size? Risk per trade divided by the risk amount. So that comes to 119. Then let's say 120 shares. 120 shares means how many? When I round it out, it is going to be 119. So let's assume that Nifty can be traded in individual stocks. Okay. Similarly, for futures, how many lots? Future lot size is 75. So instead of 119, you can only buy one lot of 75, right? You have to always round down the position size, not round up. Don't put it to 150. Keep it to the next lower round number. All right. So number of lots is 1. Now investment per share is, what is my investment? So I am going to buy it at 10655. So this becomes 10655 C20. Okay. So this is the value 10655. This is my value per share. Total investment will be 10655 into 119. That makes it P8 into 119 is the number of shares into this is the price. So this is 12,68,000. That is the amount needed to get into this trade. Okay, is this clear? And your profit is how much? 324.25 per share. So your profit is going to be 324.25 into 119. That makes it 38,585 for 119 shares. So 38,585, that means the return on investment on your capital is going to be 3%. Got it? Now similarly, when you go to the futures contract, you're going to buy only one contract of futures. The investment per share is, total investment is going to be 75,000 only, because you're buying a futures lot, right? And your gain is going to be this 75, that is the number of shares, into the entry price. 75,000 is the margin requirement for lots, one lot, right? In Nifty, approximately. So that is how the 75,000 comes here. So for one lot you need 75,000. If it was two lots, then it will be 1,50,000. Is it 90K? Okay, but for all practical purpose, let's assume, I think Nifty should be 75,000. Shashank is typing. Let me see if he's got some information. Okay. So here you will end up making 24,318 on an investment of 75,000, giving you a return of 32%. Now, is this return better than the underlying stock return? Okay. Yeah. Now let's go to what will happen if I take this as an options trade instead of stocks or futures trade. My risk is still the same. What is the risk I have per trade of options? 45 rupees. So this is what it is. 45 rupees is the total risk per share. So number of shares is 10,000 divided by 45 rupees, which comes to 222. 222 means how many shares? It's approximately 3 lots, right? So we'll make it 3 lots. Okay, we made it 3 lots. Now, what is my investment per share? I'm going to pay 354 per share, right? To buy the call option. So 354 into 75 into 3 lots. That is going to be your total investment. Got this, everyone? And what is going to be my reward? My reward is 75 into 3 into 201. Correct? So that gives me a net gain of 45,000 rupees on this trade. So if you look at this, the ROI, I make 45,000 with an investment of approximately 80,000, giving me 56% return on investment. I make 24,000 on an investment of 75,000, which gives me 32%, and I make 39,000 on an investment of 12.7 lakhs. That is giving me return on investment of 3.04. So which one has the highest return on investment? ऐसे कभी देखा है पहले कंपैरिजन? All you guys are welcome. Risk is for the stock 83.4 into, for the futures is 83.4 into 75. Correct, Chandrasekhar. Yes, but for options the risk is 45 rupees. Now if you see this, the beauty is for the same risk how your position size varies based on the asset class, which also changes your return on investment. You have to be a smart trader, right? So it is all about how I can effectively use my knowledge to make the best returns. Knowledge and efficient use of capital. 12 लाख डाल के 38,000 बनाने में कोई समझदारी का काम नहीं है. 3%. करेक्ट. सेविंग बैंक रेट से कम है. Alright, so is this clear, everyone? It's not even 3 months, Chandrasekhar. The 3 month is the expiry. The trade can work out in even 15 days, isn't it? 15 दिन में क्या टारगेट नहीं पहुंच सकता? Yeah, max is 3 months maybe. Yeah, but usually within a month you get out of this. So this is return on investment per month. But that way the calculation will be different. It might not come as 56%, but it might be still be better than anything else because you have to annualize it. Right now, this is the absolute return on investment. Or that I have assumed. So this is the risk every trader will define for himself, right? Or herself. So you have to define what is your risk per trade based on your capital. And then the calculation will flow down. No problem. Now, let's see this. The same thing, yeah, whatever. You choose 1%, 0.25, 0.25, maximum is 2% that you can take. This is long call strategy, Ramesh ji. Buy call. Now, let's assume the same demand zone when Nifty comes in. My section is going to be 2 instead of 1. Okay, I am just now making an assumption that instead of the thing being in section 1, I am assuming what if it comes into section 2? What if it comes in section 2? Is everybody with me on this? Yeah, the same trade, the Swifty trade, what I am assuming is when the stock hits this demand zone, now I assume that it is in section 1. So the next assumption is when it hits the demand zone, it is not in section 1 but it is in section 2. So how do I create my option start play? Okay, section 2 demand zone, what is your strategy? Yeah, Greeks are changed. Bull call spread. So I'm going to make here bull call spread. All right, is this clear to everyone? Now this, all this information is the same. Okay, this information is the same. Now between a long call and bull call, is my anchor still going to be the same at or below demand? So in bull call, what do? You use the same anchor as the long call, but you also add an offset above your supply zone, isn't it? That's how you create a bull call spread. And if you are not sure how to create a bull call spread, just simply refer to your this bull call spread. Buy one call at or below demand and sell one call at or above supply. And expiry is 90 days out. Just refer to this sheet and everything will be clear. So let's see, my supply ends at, I'm going to assume my supply ends at 11,000, 11,019 and odd. So which is the next strike that is available for me? 11,100. It's a daily supply, Ramesh. It's purely based on. So, but remember, Chandrasekhar, I have told you we will not use 11,050. We will instead use 11,100. See, 11,050. There is no liquidity, isn't it? 11,050. There is no liquidity here. So we will use 11,100. So Shiba, you are understanding everything, right? Yeah, no 50s. You ignore all the 50s. So the thing is, I am going to add a 11,100 call option. Again, this is going to be April expiry. Okay, guys, clear? The only thing we did is instead of a single call, I added another offset unit. Now go to Options Oracle and right click Add Row. So I'll make this as the short call with the strike as 11,100, and this is going to be my anchor, the lower one, which is long call 10,600. And same expiry 25th. All right, so now the at the current market price my credit is 280 rupees. Now see the lower summary table that you see here, this one, do you see this summary table here? This tells you the overall effect of both of them combined together, and that is what I need to understand. I don't want to know the individual leg Greeks and premiums. I need to know the collective. So I pay 432 for buying the option and I receive 151 by selling the option. So the net premium that I pay is 280 rupees, isn't it? All right, my delta is 0.27. Remember, initially the delta was 0.61. Now it has become 0.27. But is it in my the way I want it, greater than 0.25. So our offset strike is perfect. Now if you see here, if I change this offset strike to, let's say, 11,300, okay, I'm just changing it for explaining you how the delta shifts. Look at delta has now become 0.38. So the farther you go, the better the delta. And if I take this to 11,000, that is, offset is closer to my anchor. Look at how the delta has reduced now. Now this is not valid, right? So let's say you chose 11,000 and 10,600. So what you see here is my delta is 0.221. Oh, I don't like it. Why? Because my delta has to be minimum 0.25. So I just want to shift this to another strike and check. All right. I changed it to 11,100 and I got my optimum delta value of 0.27. Okay, is this fine with you guys? Okay, perfect. That's it. मेन काम तो हो गया अपना. तो इधर अभी सिर्फ आएगा 280 rupees. No, we don't leave this state. You adjust your offset strike, Suresh. You adjust your offset strike to make sure it is 0.25. Take one next offset strike. Don't change anchor, only change offset. Okay. So now, what is the cost at the current market price for this bull? So this is the total premium that you're paying to enter into this bull call spread, which is costing you 280 rupees, correct? But this is at the current market price. Am I going to enter now? I will enter when the stock hits my demand zone at 10,655, isn't it? So let's go and simulate the pricing of this bull call spread. Look at that graph. Bull call spread. Limited reward, limited risk. Then again go to today. So this is today's condition. Best case scenario is today. Worst case scenario is also today for a stop loss. So my entry point is 10,655. So I go all the way till I go to 10,655. And here what I see is, if I the option is going to reduce by 37 rupees if it comes to 10,655 today. Remember, calls are positively correlated. As the underlying goes, will your call option go down? And this is telling you how much it is going to go down by. So just drag the price to 10,655, that is your entry price. Whatever profit loss figure you see here, subtract that from the premium. That is going to be your entry price for the bull call spread. So this is going to be this minus 37. So my entry price for bull call spread is going to be 243. Similarly, worst case scenario is when you get stopped out today. Go ahead and take a look at what is going to be the change in my options premium if I get stopped out today at 10,572. So I take it down to 10,572. It's going to be 60 rupees. The option is going to reduce by 60 rupees. So now what I do is, this is going to be this minus 60. So what's my risk now per trade? 23 rupees. Entry price 243, stop loss price 220, exit the risk is 23. Similarly now, best case scenario for profit is when? When I reach the target today, which is 10,980. So again go to the options oracle, 10,980. The premium will go up by 48 rupees. Okay, the premium will be this plus 48. Now if you see, my risk is 23, my reward is 85 rupees. Okay. Correct. Oh, so this is in the planning stage. All right. So guys, good you bought this, Amit. This is in the planning stage. Now, when the stock is really close to your entry point, just revalidate these values. That's it. That my RR is still intact and my Greek values are also still intact. Just revalidate in the options oracle. And the best part is whatever strategies you create, you can save these. You save it here and you can reload it into this. You don't have to create them again and again. कुछ तो हो गया ऑप्शन oracle को. Yeah, so TT also has the option to learn. It is much more simplified. So it has been released now. Probably in the next XLT sessions, we will introduce you to all of you. It is much more simpler than this. Again, I have given input. So what I have done in the TT is, in Trade Tiger is, instead of going into all these graphs, right, I have given you a text box. In that text box, you just have to enter your entry price, the option price will be displayed. Then you enter your stop price, the option price at stopping point will be displayed. You enter your target price, the target price options value will be displayed, and you just have to enter those values. So these values you will get automatically. So these values you will get by putting in these values. That's how simple it becomes in TT. Okay. So once it comes, I will explain it to you. All right. No, but there is something happening with options oracle. So I'll have to close this. Just one moment. Hmm. क्या हो रहा है इसको? ये भी हैंग हो गया. कंट्रोल डिलीट के बाद यही आता है सर. टास्क मैनेजर ही आता है. All right. Now it is responding. This is a 32 GB RAM machine. Laptop with 1 terabyte SSD. Yeah, X1 Extreme, not even X1. This is X1 Extreme. No, फिर भी हैंग हुआ because of Trade Tiger. International है वो सॉफ्टवेयर. बाकी कोई सॉफ्टवेयर नहीं हैंग होते, सिर्फ Trade Tiger हैंग होता है. Because I have two accounts Sony. So I trade in multiple accounts. I don't trade only in one account. एक ही अकाउंट में बड़ा पोजीशन लेगा तो ब्रोकर को भी समझ में आता है कि ट्रेड क्या ले रहा है. ओके. आई थिंक एक ट्रेड टाइगर बंद करना पड़ेगा. Okay, let me just do that. Okay, let's do one thing. Let's take a quick 5 minutes break. Okay, I'll just reboot this. Okay, just a 5 minutes break. I'll be here only. Just that I'm not going to talk. 1.25 and 31875 is the reward. 75 into 5. So your stocks and future math is going to be still the same, isn't it? So you can, all right, I'm back, guys. So you can save using this and you can load using this. So when you put the save, it will ask you where do you want to save it in your in your laptop. You choose your path, save it there, and when you want to load, just load it from here. Now, so this is the bull call spread. Now let's do the math for this. So your stocks and future math is going to be still the same, isn't it? Now let's see for options what is the case. My my risk per trade is 23. So the number of shares that I'm allowed to buy is 434, which lets me use number of lots is 5.797, which is, so I'm going to take 5 lots. All right, I'm going to round it down. So 5 lots and investment per share is going to be 243 rupees, correct? And then total investment is 243 R6 into R8 into R10. 75 into 5 into per share, that is 243. That makes it 911.25, and 31875 is the reward. 75 into 5 into 85 rupees is the reward. So it gives you 31875, 34.97. Yeah, RR has gone down because the volatility condition is not matching. That's why. Okay. Now, let me copy this information. Oh, sorry, I need this. Actually, in the Indian context, right? In Indian context, the problem is that you cannot execute a bull call spread in one go. You have to execute the individual legs separately. Because of that, what happens is this is considered as a short call, right? This is considered as a short call. Yes, quite a few times, Arun. In long options, yes. Okay. So since we are going to use 5 lots here, okay, 5 lots, that means my margin requirement is going to be the premium paid plus 5 into 75,000, right? They're going to block that margin for me because I'm selling 5 lots of Nifty. So look at that. The requirement shifts to 4.6 lakhs and oh, this is not here, not here. So let me do this. Control C. Current. Ah, R6 into R8 into R10. Okay. K13. L13. I'm just changing the column names. Okay. Okay. So this is not going to be here. Here it will be again additional 5 lots into 75,000. So your investment is 4.66 lakhs for the same 32,000 that you need to make. Correct? But this is the case in case as of now. But when we have bull call spreads, yeah, that's what I did. Okay. Now, ideally, they should only block the maximum risk per trade. What is your maximum risk per trade? 243, right? I mean, limited risk, it's a debit strategy. So, worst case, you will lose only 243 rupees, not more than that per share. So, they should block your position size into 243, which is 91,000. But instead, in India, right now, they are blocking 4,66,000. Now, this is a drawback as of now in India. But eventually, it will change. Remember that. It should change. Okay, Amit, don't say not clear. Ask me specific question. I have only limited time now. I need to complete two. See, this is current, not actual. So this is what the actual thing should be. See, this is a debit strategy. In debit strategy, if you're going to buy options, when you buy options, are you having limited risk to the amount of premium that you paid, correct? So ideally they should block 91,000 only, but because India considers these two as different option trades, they don't have a bull call setup that can be taken. They will take each of these as separate legs. So, so this is the premium that they will look at 243 plus for these short options they will block margin, futures margin, which is 5 times. Since we are taking 5 lots, so it will be 5 into 75,000 rupees. Since 75,000 is per lot. So right now the same trade in India, you will need 4,66,000. Otherwise, if you do this in the US, you will need only 91,000. अरे 5 lot short है और 5 lot long है. How many lots long, how many lots short means what? Position size change थोड़ी होगा offset unit का. Okay, so is this clear? Bull call spread. So debit strategy, the P&L calculation is one and the same. Okay. Now let's quickly get into our credit strategy. Now I'm going to copy this sheet. Let me do this. Okay, now the same example, I'm going to just assume that volatility is in section 5 instead of 2. Okay, bullish. Section 5 in demand zone, what is the strategy that you're going to use? Sell a put option. Your so strategy is sell put. Right? So everything is the same, just that now which strike for sell put? Of course, Ashish, without this you won't be able to do any trades. You have to do it. But once you become expert, right, Ashish, this takes only 5 minutes, by the way. When you make those templates, right, you have to just put in your values. At or below supply, not at or above supply, at or below demand. Demand zone hai. So it's the same, just that call की जगह put होगा. And April की जगह March होगा. Because we are having 60 days or less. Okay, 60 days or less, isn't it? So instead of April, we will choose March. Okay, is everybody clear with this? Now let's go to options oracle, and now I'm going to delete this row and say short put 10,600 is at or below the distal line, and my expiry is going to be 28th March. Okay, so what is the total credit? 102 rupees. So at the current market price, the total credit is 102 rupees. Okay, but is this the real value which at which you're going to enter? No, so you have to simulate it at your entry price of 10,655. So similarly, now you go to graph and again verify delta is 0.33, which is greater than 0.25. When you go to the graph, this is the expiry graph, you go to today's graph and entry point is 10,655. It says 50 rupees. Okay, so now 50 rupees I have to add or subtract? Add, because remember puts are negatively correlated. So as the underlying drops, your put options will go up. They will go up by 50 rupees, which means 102 plus 50. That is 152. Now is this your maximum reward that you can make in this trade? So what should be your maximum risk if you are looking for a 3:1? Yeah, so it is going to be, so max risk allowed is equal to this divided by 3. So you are allowed to lose only 50 rupees, approximately 51, let's say. Okay, 51. You can give back only 51. So what you do is I need to now simulate what is going to be the option price when it hits my stop loss at 10,572. So similarly, I'll go and check at this 10,5. It's going to be 92 rupees approximately. It's going to increase by 92 rupees. So that is going to be the current market price value plus 92. So it's going to be 194 and the risk I have is 142. So do I have a 3:1? This I don't need to calculate for target. Remember this. I have a 3.62 is to 1. That's it. So this is a valid trade. Why? Because I'm getting 3.62 is to 1. Now this I'm not going to do. This is the same thing you have to keep on doing. Okay. I'm not going to do this. I'll just delete this. So I don't have the time to do all the calculation. So this is how you do for credit. For credit, you don't need to look at the target price. Why? Can anybody tell me? Because you have already received the maximum profit and you don't need the stock to go all the way to your target. If the stock just hovers around there and time passes, you will still make money. Correct? So this is, so you get a credit of 152. So 10% of this is 15. So when the value of this option becomes 15, you will exit. All right. This is sell put. Now bull put will also be very very similar. It's just that for bull put you'll have to add another strike here below. Okay, just put another strike here, put that strike in options oracle, and that's it. Everything is just like a long call, or bull call. So I've completed two examples for debit and one example for credit. Now I'm going to spend time to complete one example for a non-directional strategy. So let's say here we will on the same chart of Nifty, let's assume that this is going to be my supply. So that's my non-directional. So I'm assuming that it is going to remain in this range. Okay, nobody is saying anything. I mean, either everybody is understanding or everybody is busy. So I see it is very difficult to understand when you're in online class. So I need constant confirmation from you when I ask yes, no, yes, no, yes, no, so that I can move ahead faster. All right, perfect. Okay. So now what I'm going to do is I'm going to, okay. So these two are, so let me delete the internal ones. Okay, वो मैं बाद में delete कर दूंगा. Okay, so let's say this is what I am looking at as a non-directional play ranging between these two. So let me just put these values here. Okay, script is nifty, outlook sideways. Okay, this is double. And my supply zone is 11069 to 1118. So here I have to add the DTR. Okay, and here already the DATR is added. Current market price is 10,791. DATR was how much? Guys, do you have any idea? 113 now. Okay. All right. So short strangle. What is short strangle? You're strangling the price between your um, supply and demand zones and expecting it to remain in that range. So at or below the stopping point of the demand and at or above the stopping point of the supply. So this is wrong value. Let me take these. Oh God, I did it in the wrong sheet. All right, so this is 11069. Again the same mistake. All right. So my strategy is going to be short strangle because it's a sideways thing. That's my current market price. All right. Okay. So when you do short strangle, okay, when you do short strangle, your strike selection is going to be what? So at or above this and at or below this. So here it is 1129. So I'm going to choose 7200. That is above the distal line. And since I'm selling, it is going to be March expiry. Right. Similarly, on the demand side, I'm going to choose on the demand side, I'm going to choose minus 10,600 C March 19. P. This is going to be P and this is going to be C. Alright, this is how you create a short triangle. Okay, so now simply go to options oracle, add one more row. I am going to short a call option and I'm going to short a put option. My strikes are 11,200 and 10,600. Alright, so what I get is 62 rupees. Wait. Okay, what I get is not 62, it's 146 rupees. So credit PNL is, so the PNL is 146. Now this is what you're going to get. There is no simulation of pricing at entry price, because for a short triangle or non-directional, the entry price is whatever time you want to enter. You're looking at it now. If everything is fine, this is what you enter at. Got it? Okay. Now just find out your stopping points at this and this. So this is my stopping point, isn't it? That's my stop point here, and this is my stop point here. Okay, so what I have to do is I have to now go to and look at this delta. Is it less than 0.25? Yeah, so this is fine. So I go to the graph. This is a short triangle graph at expiry. I go to today, and what's my upper stopping point? 11129. Yeah, this is delta neutral. So upper stopping point 11129. Approximately 31 rupees is what you're going to lose. So at the, if you get stopped out at the upper point, okay, 32, I can give you 32, no problem. Okay, and similarly at the lower point, it's 10572. $65 approximately. 65. What is the max risk allowed? One third of total credit, that is going to be 146 divided by 3, which is 48. Now this is passing, but here if you see, it's more than that, right? So this is not a valid trade. Sorry. So this is not a valid trade. This also number should be below 48. Both sides need to meet RR. Do you really know which side you might get stopped out? Alright. So this is how you do the reward to risk calculation for non-directional. Now if this has to be converted into a bull iron condor, just add your offset units here and do the same thing. That's it. Just add offset units in options oracle and write it here. Add two more rows, offset this, and then look at the graph. It will be different. That's how simple the calculation is. So what you need to know from this is, do not look at any of these values. Only press whatever, put in whatever script you want to do, say, okay, say when you enter it will get data, then you add rows, whatever strategy you want to construct. This is the summary, and you go to the graph. That's it. There is nothing else that you have to do. Okay. Any questions, guys, on the RR calculations? And don't worry, if you do not understand completely, right, we are going to do this day in, day out in XLT. We do this only. And at least in my class, there is no trade without options oracle. Let me show to you how I create the XLT sheets. So those who have attended my XLTs are already aware of it. And this is how I maintain my log as well. So you see this is how I create. This is my log also. So I have all trades that I've taken in options, be it XLT, non-XLT, everything is in this sheet. Let me show you from when. You will be surprised. And you will know that this is the kind of work that I have done in options. You know, I have been trading options when Arcom was trading at 160 rupees. Yes. Got it? This is when Arcam was trading at 158 rupees, McDowell's was trading at 3000 rupees. Kane India was trading at 402 rupees. And Jindal Steel was at that point an optionable stock with 238. Reliance. So all these strategies. So most of them are. So this it's since then that I have been doing it. All right. No, IV is not done manually. IV you get it here in the. This is the IV part. So if you see the red line is your IV line. No, no, no. That was some. I think some. I was explaining to somebody maybe. Ah, that time we used to do all these IV calculations manually. Yes, yes. Because that time this tool was not ready still. It was not even. I don't know whether it was designed also or not. Shreyas, you were there, right? The blue line is HV line. You don't need that blue line. Forget the blue line. Only the red line is important. Where is the red line between those gray lines? That's it. Blue line is the HV line. It is like shooting in the dark, Chandrasekhar. You don't get short strangle very often. I mean, IV has to be in section 5 and the stock also has to be non-directional. So it's the spreads, the credit spreads that I do quite often. Default settings, so I'll give you, just take a snapshot of this. Alright, all of you just take a snapshot of this. I'll tell you now. We'll begin with this. And one more sheet, the summary, this sheet. We had options oracle, Shreyas, but remember in the middle options oracle stopped and we did not have IV. I can't zoom this. Done, everybody? I can't zoom, Krishna. You have to take an image and zoom that image. I'm sorry, because see, how can I zoom this? There is no maximize button also. So the spread and volume is must. Sony, you can be a little compromising on the total number of contracts. Instead of 10,000, even 8,000 or 7,000 or up to 5,000 is fine. Okay, guys, don't worry. What I will do is I will paste this image in the Excel sheet that I'm going to send you. So all of you will have it in the Excel sheet. Don't worry. यार अबरार 5 दिन के बाद तुमने सवाल पूछ के आज मुझे खुश कर दिया. This is the simplest way to trade options. Absolutely. Remember, so everybody's done. Now I'll start winding down and tell you how to go ahead. Oh, yes, so that is one thing. How to figure out. No, no, if buying future and IV has nothing to do with each other. Remember one thing, Pudupet and all of you, futures and options are not correlated. They are two different instruments. They both are related to the underlying, not to each other. Unless there is options on futures like commodities or even index. In the US, there are futures on there are options on index futures and there are options on only index. Say something about options pain in Oracle, nonsense. That is what is option pain. कुछ नहीं, ऑप्शन पेन वगैरह कुछ नहीं होता. By the time you figure out what is the pain, right, everything is gone. You will not make money. If option pain, volatility, smile, if all those were important, right, they would have been introduced in this course. It's not needed. All right, so when you now go to tools and you see this one click filter, okay, in the condition name you go to XLT IV level, okay, pay attention. Tools, one click filter, go to condition name, select XLT IV, and then choose whichever zones you want, and then run condition. All these stocks are available in section 5. Check which are optionable in this and go and trade those stocks. Yeah, I don't use it. I'll tell you why not to use this, okay? Listen to me. I'll tell you, even if you use it, verify your IV level on the chart. I'll tell you why. I have seen students doing this. They just go, look at section 5, go to the stock, and ऐसे थोड़ा ऊपर का स्ट्राइक चूज करके कॉल सेल कर देते हैं. So what is the step that they are avoiding? Core strategy. This is the reason, and I don't advocate this. So in core strategy, it is the boring candle or the basing candle, now what it is called, the blue color, and here this, I strongly tell you not to use it. I mean, I can only tell you, finally everything is up to you, but avoid using them. So is this clear? Anything else that you want to know? If you have that discipline, Puru, please go ahead. But I'm telling you, you won't be that disciplined. या बट पीपल डोंट डू एनालिसिस चंद्रशेखर, दैट्स अ प्रॉब्लम. सब लोग देखते हैं और ये भी नहीं. मैं तुमको लिख के देता हूँ, तुम ट्राई करो. अभी तुम टाटा केम देखोगे, सीधा टाटा केम का चार्ट खोल दोगे और बोलोगे मैं टाटा केम में पुट राइट करूंगा या कॉल राइट करूंगा, बट ये भी चेक नहीं करोगे कि कैन आई ट्रेड टाटा केम इन ऑप्शंस. कर लो, आजमा लो. Isn't there an XLT IV under NSE options as well? What is that, Amit? अरे प्रेम, वो जब एक्सेल शीट भेजूंगा ना उसमें आ जाएगा वो, डोंट वरी. So I'll send you a sheet like this. This is a November sheet in which you'll have all the list of optionable scripts. Don't worry. How much time I get before underlying moves to trade in option? I didn't understand your question, Pudupe. No, no need TT option calculator, Anand. Rameshji, that is not how you can do. It all depends on the IV section. If IV is in 1, then you can go and buy a call option at demand or buy a put option at supply. But if IV is in 5, you can't do anything. Or IV is in 2, 3, 4, you can't do these strategies. So you'll have to adapt yourself. Don't be in a hurry, Rameshji. You right now focus only on getting your core strategy correct, and at the same time keep on revising options. No, Pudupet. Script movement and delta. Delta will tell you how fast or slow the script, the option premium is going to move. You can't really do anything, Prem. The problem, this problem, you'll have to then hold on all the way to that, or if you are in like 400 rupees profit and you have to give 25 rupees back to the market because of the spread, just do that. But frankly speaking, I really still not have had such an issue in options trading, because most of my trades have been credit trades. So that problem comes only in debit trades, it doesn't come in credit trades. What about advanced option chain? Advanced option chain is where the a similar tool like Options Oracle is going to be is available. So we will explain that in XLT. Yeah. So I am going to now. No, these are prime, and then XLT strategies like primarily Iron Butterfly, breakout for free, and then Iron Butterfly breakout for free. That's it. And and section 2 1 2 4 5 and non-directional Iron Butterfly, Iron Condor, short strangle, short straddle, and breakout for freeze. Yes. So actually, I think it is updated, but my system is not updated. Reason being, everybody told me not to update since the latest version of TT is very slow. So that's the reason I have not updated it. So probably April onwards, the all the classes will be taught using the new options, TT options oracle, and not this options oracle. BFF 3, 4, and 5. Okay, it's every. Okay, now I will have to close the recording and then answer your question. I'm ready to extend the session by 15 minutes to tell you how to begin, but then it won't be recorded. Remember that. Why? Because otherwise the recording, this recording of RR calculations won't get uploaded. Okay. So everybody is done. So once I get so don't expect me to send you the email today itself, and I don't want you to study anything today also. So today is the end of day 5. What you have to do is you have to simply do something else but options. Go watch a movie, do whatever. It's weekend, have your beer, rum if you're drinking. If not, watch movie, do everything, but don't do anything in options. Let your brain settle down. Okay. I will send this dot. Yeah, go for total dhamal. Probably that will be a better idea. दिमाग पूरा खाली हो जाएगा. बोलेगा options better था total धमाल से. Yeah. So I will send you by tomorrow or latest by Sunday morning all these documents, because now what I'm going to simply do is shut down the computer and not even look at it today. I need some rest. I need some greenery for my eyes. I've been only looking at these red candles. Okay. हाँ देखते हैं यार, ये इधर ही ध्यान जाता है सीधा. All right. So is everybody done with any questions in options? All right. So hold on. Don't leave. Hold on. Okay. Yes, Karanjit, you can mail. Don't worry. Now so is it okay? I'll just stop the recording and I'll tell you how to start with it. Okay. All right.